Welcome to the Deep Dive, your shortcut to getting smart on the stories that really matter. Today, we're diving deep into the fiscal third quarter 2025 results for Mission Produce. We've pulled apart their latest earnings call, looked at the analysis, really trying to uncover the strategic plays behind what looks like a pretty impressive quarter.
Yeah, it was definitely a strong one. And this deep dive, it's really about understanding how Mission Produce used its operational muscle and that vertical integration, how that allowed them not just to meet expectations, but actually blow past them pretty significantly. Sets a really interesting stage for what's coming next, I think.
Okay, let's jump right in then. The headline numbers. Mission Produce, wow, really delivered a robust Q3. Consensus estimates, they were left in the dust.
They really were. So non-GAAP adjusted EPS came in at 26 cents. The street was looking for something closer to, $1.15. So a big beat there.
Huge beat. And revenue.
Revenue also strong, $357.7 million. That smashed the consensus estimate of around $329 million. And importantly, that's up 10% year over year.
10% year over year. And it wasn't just revenue growth, was it? The profitability looked pretty good, too.
Exactly. Gross profit surged 22% compared to last year, hitting $45.1 million. And that pushed the gross margin up 120 basis points, so 1.2 percentage points, landing at 12.6%.
That margin expansion is really key, isn't it? Especially given some of the, let's say, pricing dynamics they were facing.
Absolutely. In this kind of market, seeing margin go up like that is noteworthy. And, the market definitely noticed. The stock reacted positively. It wasn't just a beat. It felt like validation of their strategy, a constructively bullish response, you could say.
Oh, those headlines, they only tell part of the story, right? Let's peel back the layers. How do they actually manage to expand margins when avocado prices were, falling? Volumes were up 10%, yes, but average prices down 5%. How's that math work?
Right, that's the fascinating part. It really speaks to the resilience of their model, particularly that vertical integration and their global sourcing setup, the volume growth that came mainly from better supply, especially more avocados coming out of Peru, and better availability from Mexico, too.
Okay, so supply was good, but the margins.
The margin expansion, that was heavily driven by their international farming segment. They just had much better yields at their Peruvian farms this year. So it's not just more avocados, it's having control over those sources, getting better costs, even when the broader market price might be softening. That diversification pays off.
Got it. Now, digging a bit deeper into costs, adjusted EBITDA was up about 3% to $32.6 million. Okay. But SG&A expenses, selling, general, and admin, those jumped 19%. That seems high. What's driving that?
Yeah, that definitely catches the eye. It's an important question. The main driver there was higher employee-related costs. Think incentive pay, performance-based stock compensation, that sort of thing. And a lot of that was concentrated in that high-performing international farming segment.
Makes sense, right? Strong performance triggers higher bonuses.
Okay, so it's tied to performance.
Exactly. Over half of that SG&A increase was specifically linked to these variable costs. So when they have a record quarter like this, those costs go up. But if things were tighter, those costs would naturally be lower. It's not necessarily a structural increase in their fixed cost base, which is key.
Right, that makes sense. It's more like sharing the upside. Okay, let's look at the segments. Marketing and distribution sales up 7%, which sounds decent, but its adjusted EBITDA was actually down. How does that fit the positive picture? Yeah, good point. If you look at the bigger picture, the per unit gross margin in marketing and distribution basically just normalized. It returned to more historical levels. Last year, those margins were, frankly, unusually high. So this year looks like a dip, but it's really more of a reversion to the mean, not a sign of weakness in the core distribution business.
Okay, so M&D was stable-ish, returning to normal.
Pretty much. The real engine for the quarter, the standout performer, was absolutely international farming. Sales there shot up 79% to $49 million. And adjusted EBITDA, it skyrocketed 163% to $12.1 million. That's almost entirely down to that strong recovery in Peruvian production we talked about. So one segment normalized, the other just hit it out of the park. Shows the strength of having both.
And how's their financial health looking? Cash? Debt?
Looking solid. They ended the quarter with $43.7 million in cash. And crucially, they generated $34 million in operating cash flow just in Q3. That's strong.
And CapEx, they've been spending quite a bit on facilities, haven't they? Is that slowing down?
It seems so. Year-to-date CapEx was about $39.8 million. Their full-year guidance is $50 to $55 million. And management specifically said these big CapEx programs are, quote, nearing completion. That's a big signal. It suggests a shift towards generating significant free cash flow in the coming periods as those investments start paying off instead of costing money.
And debt levels.
Very manageable. Their net debt to adjusted EBITDA leverage ratio is roughly 1 time. That's quite low, giving them a lot of financial flexibility going forward.
Okay, shifting gears to what management was saying, they kept highlighting record fiscal Q3 revenue and gross profit. They really attributed it to that vertical integration and ensuring they had supply, didn't they? The CEO, Steve Berard, praised the commercial team's execution in moving fruit globally.
Absolutely. That was a consistent theme. Vertical integration, supply continuity, execution. And the COO, John Pulaski, he really hammered home the point about their operational sophistication and global reach. He specifically mentioned how having strong Peruvian production this year, combined with better Mexican supply, allowed them to really optimize their sourcing mix. That's their core advantage, playing the global map.
So they can essentially shift where they source from based on who has the best crop or best cost at the time.
Exactly. It helps smooth out the bumps that you inevitably get with agriculture in any single region.
Right.
It builds financial consistency.
And they're not just sitting on their existing network, right? Expansion seems to be ongoing. Europe up 37%, new customers in Asia. Plus those big infrastructure projects upgrading capacity in Mexico. That new packhouse in Guatemala opening back in April.
Yeah, those are really important long-term strategic moves. That Guatemala packhouse gives them year-round supply potential closer to key markets like the U.S. East Coast. The Mexico upgrades are about efficiency, getting ready for the next harvest cycle there, probably learning some lessons from past seasons.
And diversification. It's not just avocados anymore.
Right. They're applying the same kind of playbook, build scale, control supply to mangoes, trying to grow market share there. And blueberries are becoming a much bigger piece of the puzzle. They're expanding acreage, expecting to get over 700 hectares soon, with meaningful volume growth expected there in the next few years. It helps reduce their reliance on just one crop.
Okay, so Q3 was great. Strategy seems clear. But what about the immediate future? What's the outlook for Q4? Sounds like a bit of a mixed bag. More avocados, but maybe lower prices.
That's exactly the forecast. Industry volumes for avocados are projected to be up maybe 15% year over year in Q4.
Right.
But, and this is a big bump, but pricing is expected to be significantly lower, down maybe 20-25% compared to Q4 last year, which had pretty high prices.
Oof. So a classic volume up, price down scenario. That puts pressure on margins, doesn't it?
It absolutely does. Q4 is going to be a real test of their execution, their ability to manage that mix, control costs, and defend the margins they achieved in Q3. The spotlight is definitely on them to navigate that pressure.
What about tariffs? That came up on the call. They mentioned a $10 million annual impact.
Yeah, they quantified it at about $10 million annually, direct impact. Said about $5 million of that had been incurred year to date. But they framed it as, relatively modest in the grand scheme of things, less than 1% of their total cost of goods sold.
So it didn't force them to drastically change where they send avocados.
Apparently not. They stated pretty clearly they didn't materially shift product placement because of the tariffs. They prioritized following the demand. It speaks, again, to the flexibility of that global network. They could absorb the cost or adjust pricing rather than making huge logistical changes.
Then are they still planting new avocado trees everywhere? Or has that expansion phase peaked?
Seems like it's peaked for avocados and mangoes, at least for now. Management said no major plans for new avocado planting. The focus now is on getting more out of the acres they already have, improving yields as those trees mature, optimization over expansion.
But blueberries are still growing.
Blueberries are the exception, yeah. They're still on track to reach about 1,000 hectares eventually. Expect significant production increases there over the next few years. But broad-scale capital investment in new acreage beyond what's already committed, management indicated that's not really in the 3 to 5 year plan. They're shifting towards harvesting the returns from past investments.
So pulling this all together for someone looking at the company, this quarter really seems to underline their core strategic story, doesn't it? Vertical integration as a hedge against volatility, driving steadier results even when prices swing wildly.
Exactly.
Yep.
That's the narrative in action, delivering these kinds of results, beating expectations while completing major projects like the Guatemala packhouse. It really builds management credibility. You can see the multi-year plan shifting. It used to be all about just managing volatility. Now it's moving towards leveraging their scale, their network density, underpinned by having diverse sourcing options and these efficient packhouses.
It's like they're trying to turn a volatile commodity business into something a bit more predictable.
That's the goal, I think. using that global network to kind of smooth out the regional bumps, turning that volatility potentially into a source of advantage if they source smartly.
And the market seems to be buying into this story, at least recently. The stocks outperformed the S&P 500 over the last month, 3 months, even the past year. That's pretty telling for a produce company.
Yeah, that outperformance isn't random. It's clearly tied to those favorable supply conditions they managed to capture from Peru and Mexico, the record revenue, and that big rebound in international farming profitability. Looking ahead, for investors, the things to watch are, can they execute in Q4 despite those price headwinds? Does international farming keep delivering? And what are the real tangible benefits coming from those new pack houses as we cycle through the seasons?
Okay, we covered the results, the strategy, the outlook. Now let's shift to our favorite segment, not financial advice. Time for an outrageous but plausible trade idea, just something to chew on. Remember, this is purely hypothetical.
All right. So given the strong Q3 big volume, good margins despite lower prices, but facing that Q4 outlook even more volume, much lower prices, here's a thought. You could construct a thesis around Mission Produce's long-term strength. That vertical integration, the diversification into blueberries. Maybe that warrants a long position in the stock itself, right? Believing in the core strategy.
Okay, the long-term bull case, but hedge the short term.
Exactly. To hedge against that potential Q4 margin squeeze from the falling prices, you could simultaneously look at something like a short-term, maybe out-of-the-money put option spread. The idea would be to potentially capitalize if the market overreacts negatively to those Q4 price declines in the next earnings report.
While still holding on to the belief that the company's underlying strengths, blueberries, global network, etc., will win out long term.
Precisely. It's a way to play both sides. Acknowledge the potential short-term commodity price pain while staying invested in the longer-term structural advantages they seem to be building. A play on structure and volatility. Again, purely hypothetical.
All right, let's wrap this deep dive up. To recap, Mission Produce. A very strong Q3, beating expectations significantly, driven by solid execution, that booming international farming segment thanks to Peru and their integrated model.
Yeah, but Q4 looks challenging. Volume up, price down. It's going to test their operational discipline. Still, the ongoing investments in capacity, diversification into things like blueberries, it's all aimed at building resilience for the long haul, making them less dependent on just one crop in one region.
They really are trying to build a model for consistency in what's usually a very bumpy industry. Leveraging scale, leveraging that global network to try and smooth things out.
That's the core story, absolutely. Scale and network density mitigating market swings.
So we've scratched the surface of Mission Produce's quarter. Now, here's something to think about. If a company like Mission can build this kind of strategic resilience in fresh produce, arguably one of the most volatile commodity sectors, what does that signal for other industries that deal with similar price swings? Are they just lucky this time, or have they genuinely figured out a better model for stability? As always, we encourage you to dig into the details yourself. This is absolutely not financial advice. Always consult a qualified professional before making investment decisions.
Thanks for tuning into the deep dive. We really appreciate you joining us, and we look forward to the next time we get to unpack the markets.